If every major economy reports massive national debt, the obvious question is, who is on the other side of the ledger? The numbers look contradictory at first glance. The United States owes over $34 trillion, Japan's debt-to-GDP ratio exceeds 250%, European economies collectively hold trillions in liabilities, emerging markets borrow heavily from global capital markets, yet the global system hasn't collapsed and no single entity appears to be collecting these obligations. Understanding why requires looking past the headline numbers and examining how sovereign debt actually works, who buys it, and how the structure of modern finance turns global debt into a series of interconnected claims rather than a simple borrower-lender relationship. Before modern states issued bonds, governments financed themselves through land taxes, trade tariffs, or wartime plunder. Large-scale borrowing was rare because reliable capital markets did not exist. That changed in the 1600s when England created one of the first permanent national debt systems. Investors could lend to the government through standardized bonds. The debt was not meant to be paid off entirely. It functioned as a rolling obligation, continuously refinanced to support military spending and state administration. This model spread, and by the 19th century, national debt had become a normal tool of fiscal management rather than an emergency measure. The modern structure of sovereign debt emerged in the 20th century with the expansion of central banks, regulated banking systems, and institutional investors. Today, when a country issues debt, it sells bonds to a wide variety of buyers: domestic financial institutions, households investing through pension funds, foreign governments, multinational banks, and in many cases, the country's own central bank. This diversification is important. It means that when a government says it is in debt, the majority of what it owes is held by entities inside its own borders. In other words, much of global sovereign debt is internal rather than external. The United States is the clearest example of this structure. A significant share of U.S. federal debt is held by American institutions: pension funds, insurance companies, mutual funds, banks, and the Federal Reserve. When the government pays interest on this debt, the payments circulate inward. They go to U.S. retirees, U.S. investment funds, and U.S. financial intermediaries. Foreign governments do hold a portion, but their share has been declining for over a decade. Japan and China remain major holders of U.S. treasuries, but the majority stake is domestic. This pattern is not unique to the United States. Japan's national debt is overwhelmingly held by Japanese institutions and the Bank of Japan. The same applies across Europe, where domestic banks and pension funds are primary bondholders. This creates a circular financial system in which governments borrow from the same institutions that depend on government bonds for stability and income. A pension fund purchasing government bonds is not simply lending money to the state, it is participating in a safe asset ecosystem that anchors retirement savings and bank balance sheets. Government debt, in this context, acts as a form of financial infrastructure. It provides a low-risk asset that institutions can hold, trade, or use as collateral. The purpose of the debt is not solely to finance current spending, it is to supply the financial system with a dependable liquid instrument. To understand why every country appears indebted at the same time, it helps to look at the mechanics of global capital flows. When one government issues bonds, investors buy them with capital that originates somewhere else in the economy. If foreign investors buy domestic debt, the bond becomes a claim held abroad. If domestic investors buy it, the liability and assets sit within the same national balance sheet. Globally, total debt is high because modern economies rely on credit to expand production, stabilize savings, and support investment. But debt balances do not imply a single global creditor. Instead, they represent a network of claims held across households, banks, funds, and governments. Historically, truly external creditors, meaning foreign powers capable of forcing repayment, played a much larger role. In the 19th century, emerging states borrowed heavily from European banking houses. Defaults could trigger military or political intervention. But after World War II, new institutions such as the IMF and World Bank reframed international lending. Instead of private bankers dictating terms, multilateral frameworks emerged to stabilize global finance. The creation of strong domestic capital markets and advanced economies further internalized debt ownership. The consequence is that national debt today functions as an internal policy tool more than a geopolitical vulnerability. Even when countries do rely on external borrowing, their creditors are usually diversified across global institutions rather than a single state. For example, many developing countries borrow from international bond markets, where the creditors are pension funds, hedge funds, and sovereign wealth funds spread across dozens of countries. The creditor in these cases is not a nation, but a distributed group of investors managing trillions of dollars. This shift also explains why countries can sustain higher debt levels than in the past. When a government owes money to its own central bank, the relationship is different from owing money to a foreign government demanding repayment in gold or hard currency. The central bank can roll over bonds indefinitely, adjust monetary policy, or alter the maturity structure of the debt. Debt held domestically becomes a policy instrument rather than a rigid obligation. But this doesn't mean the system is risk-free. Debt held internally can still create vulnerabilities. If a government issues too much debt, it can crowd out private investment, destabilize interest rates, or undermine confidence in its currency. If external debt becomes too large, countries may face balance of payments crises, as seen in Latin America in the 1980s or emerging markets in the 1990s. The global financial system contains both internal stabilizers and external pressures, and countries must balance them.
To understand who the creditors actually are, it helps to sort them into categories rather than imagining a single entity holding the world's debt. The first category is domestic financial institutions. Banks, insurance companies, and pension funds need safe, predictable assets to meet regulatory requirements and match long-term liabilities. Government bonds serve that purpose. For pension funds, government debt provides a reliable income stream to meet future obligations. For banks, it acts as high-quality collateral and counts toward capital adequacy rules. This institutional demand ensures that governments can issue large amounts of debt without depending solely on foreign capital. The second category is households. Many individuals indirectly hold government bonds through retirement accounts, mutual funds, or life insurance policies. When people save for retirement, a portion of their contributions often flows into sovereign debt. This means that a significant share of national debt is effectively the public lending to itself through financial intermediaries. Interest payments become a transfer within the economy rather than a drain to an external creditor. This internal loop helps explain why advanced economies with strong financial systems can maintain high debt levels while remaining stable. The third category is foreign investors, which includes sovereign wealth funds, foreign central banks, and global financial institutions. These actors buy government bonds to manage foreign exchange reserves, diversify portfolios, and maintain liquidity. For example, China and Japan hold U.S. treasuries as part of their reserve strategy. Holding U.S. debt supports exchange rate stability and provides a safe place to source surplus capital from trade surpluses. Similarly, European funds and Middle Eastern sovereign wealth funds hold debt from advanced economies because it offers liquidity and predictable returns. Foreign holders matter for international financial integration, but they are rarely dominant except in specific emerging markets. The fourth category is the central bank. When central banks purchase government bonds, they modify the structure of public debt ownership. This is most visible after 2008 when quantitative easing became widespread. Central banks accumulated trillions in government bonds to stabilize financial markets and support economic recovery. In these cases, the government owes money to an institution it effectively controls. This transforms part of the national debt into an internal accounting position. While the bonds still exist on paper, the interest payments flow back to the Treasury through central bank remittances. Debt monetization changes the distribution of creditors and influences interest rates, asset prices, and liquidity across the economy. These four categories show that national debt is not a simple liability owed to an external power. It is a network of financial claims that provides structure to the global economy. When every country appears indebted, it reflects the scale of modern financial interdependence, not a hidden lender. Global debt is high because sovereign bonds function as the backbone of global finance. They are used as collateral for loans, benchmarks for interest rates, and safe assets during market stress. To understand how this structure evolved, it helps to look at the last 50 years of financial globalization. In the 1970s and 1980s, rising oil prices generated large surpluses in oil-exporting countries. These surpluses flowed into Western banks, which then recycled the capital as loans to developing countries. This system created real external creditors, and when countries struggled to repay, the result was the Latin American debt crisis. The 1990s introduced a new model driven by international capital markets rather than banks. Countries issued bonds directly to global investors, diversifying their creditor base, but also exposing themselves to market volatility. The Asian financial crisis showed the dangers of sudden capital flight and currency mismatches. In the 2000s, global imbalances grew as the United States consumed more than it produced, and countries like China exported more than they consumed. The surpluses accumulated by exporting nations were reinvested into U.S. government debt. This created a loop where U.S. consumers bought foreign goods, foreign economies earned surpluses, and those surpluses were recycled back into American financial markets. The creditor in this arrangement was not a single country, but a distributed network of global investors and foreign reserve managers tied into U.S. consumption and global trade. After the 2008 financial crisis, central banks became the dominant marginal buyers of sovereign debt in many advanced economies. Their purchases restructured debt ownership and suppressed interest rates. As a result, government borrowing costs fell even as debt levels rose. The relationship between states and their creditors became more internalized. Much of the debt accumulated during this period was held by domestic institutions rather than external investors. This helped countries avoid the classic external debt crises that were common in earlier decades. However, emerging markets still face pressures from external creditors when their debts are denominated in foreign currency. Countries that borrow heavily in dollars or euros cannot print the currency they owe. This creates a vulnerability when exchange rates weaken. Argentina, Turkey, Sri Lanka, and several African nations have experienced crises triggered by external debt imbalances. In these situations, the creditor base is more concentrated in international bondholders, multilateral institutions, and foreign banks. Unlike advanced economies, these countries cannot rely on their central banks to absorb large amounts of debt without risking currency instability. One important misconception is that if every country is in debt, the system must be unsustainable. In practice, global debt works because for every liability, there is a corresponding asset. A government bond is a debt for the issuer, but an asset for the holder. When a country increases its debt, someone else increases their holdings of safe assets. Global finance operates through this balance. The issue is not that everyone owes money, the issue is the distribution of who holds the claims, what currency the debt is denominated in, and whether the economic base can support the liabilities over time. A key dynamic in the modern system is that some countries run persistent surpluses while others run persistent deficits. Surplus countries accumulate foreign assets, including foreign government bonds. Deficit countries issue debt to finance consumption and investment. This does not create a single global creditor. Instead, it creates long-term financial linkages where capital moves from surplus regions to deficit regions in exchange for safe assets and returns. The creditors in these relationships are spread across households, funds, and governments around the world.
To answer the core question, if every country is in debt, who is the creditor, the most accurate explanation is that modern debt is a web of internal and external claims spread across millions of institutions and individuals. But the structure of this web produces some consistent patterns that define how the global economy functions. The first pattern is that advanced economies owe most of their debt to themselves. In the United States, Japan, the United Kingdom, and much of Europe, domestic institutions are the primary bondholders. This means that when these governments pay interest, the money stays within the national economy. It goes to retirees, financial institutions, and central banks that, in many cases, return profits to the Treasury. The debt is a liability for the government but an asset for the private sector, creating what analysts refer to as a closed loop. The system reduces default risk because governments are not pressured by external creditors demanding repayment in foreign currency. The second pattern is that international capital markets act as a decentralized global creditor. When emerging markets issue bonds, the buyers are not typically other countries but global investment funds, banks, and institutional investors. These entities pool capital from around the world and deploy it in search of yield. The creditor is not a nation-state but a diversified portfolio of investors operating within global financial markets. This disperses risk but introduces volatility. If investor sentiment shifts, a country can face sudden capital outflows, driving bond yields higher and weakening its currency. This mechanism has triggered numerous crises in emerging markets over the past 3 decades. The third pattern involves sovereign wealth funds and foreign reserve managers. Countries with large trade surpluses accumulate foreign currency and reinvest it in safe assets abroad. U.S. Treasuries, European government bonds, and other high-grade securities serve this role. These reserve managers are significant external creditors but operate with clear incentives: stability, liquidity, and the preservation of capital. Their holdings reflect global trade imbalances rather than political leverage. When China or Japan buys U.S. debt, it is not functioning as a lender of last resort. It is recycling surplus dollars earned through trade to maintain exchange rate stability and secure low-risk returns. The fourth pattern involves the role of multilateral institutions such as the IMF and World Bank. These organizations lend to countries experiencing financial distress or structural weakness. In these cases, the creditor is explicit and external. The terms involve policy reforms, repayment schedules, and monitoring, but this category represents a small share of global debt. It is primarily relevant for low-income or crisis-stricken economies rather than advanced or middle-income countries with established capital markets. The fifth pattern involves debt held by central banks, which has become more prominent since 2008, the financial crisis, and accelerated during the COVID-19 pandemic. When central banks purchase government bonds, they convert a portion of public debt into intra-governmental claims. The government owes money to its central bank, but interest paid often returns to the Treasury. This reshapes the creditor structure and allows governments to stabilize financial conditions. It also explains why borrowing costs remained low even as global debt reached record highs. These patterns make clear that the global system is not structured around a single creditor. Instead, sovereign debt is embedded in a network of financial institutions, savings mechanisms, and international linkages. The question is not who is the creditor, but how are claims distributed and how do they influence economic stability? A useful way to understand the system is to view sovereign debt as financial infrastructure. Just as roads and utilities support physical activity, government bonds support financial activity. They provide collateral for loans, benchmark interest rates, and safe storage for savings. This infrastructure requires constant issuance and rollover. Countries do not aim to eliminate their debt but to manage it sustainably. As long as economic output grows and institutions remain credible, high debt levels can coexist with stability. However, the distribution of creditors matters for risk. When debt is primarily domestic and denominated in a country's own currency, governments have more control. They can adjust monetary policy, influence interest rates, and coordinate with domestic institutions. Japan's extremely high debt-to-GDP ratio is sustainable largely because most of the debt is held at home. The government and central bank manage the financial environment in which the debt exists. When debt is primarily external and denominated in foreign currency, countries face greater vulnerability. They must earn foreign exchange to repay creditors, making them sensitive to export export performance, exchange rate fluctuations, and global interest rates. This is why some emerging markets experience repeated debt crises even when their overall debt levels are lower than those of advanced economies. One final misconception is that global debt implies the world as a whole is indebted. Debt is always a relationship between borrowers and lenders. Globally, the total amount of debt equals the total amount of financial assets. The balance sheet of the global economy is symmetrical. The real questions involve distribution, concentration, and the ability of economies to service their liabilities without destabilizing growth. When commentators say every country is in debt, they are referring to sovereign liabilities, not the existence of a single global creditor. The real creditors are households saving for retirement, domestic financial institutions managing risk, foreign reserve managers seeking safety, investment funds allocating capital, and central banks shaping monetary conditions. These actors form a decentralized system in which debt circulates as a critical component of economic activity. In practical terms, the world's creditor is the world itself, operating through a complex, interconnected financial network rather than a single entity. Debt persists because it facilitates investment, stabilizes savings, and underpins global markets. The system is sustainable not because no one is owed, but because the obligations are distributed and continually renewed through the mechanisms of modern finance.